What is CFD trading?
Hello and welcome to this educational video. What are CFDs? Well, let's take a look in the platform.
CFDs, or contracts for difference, offer a cost-efficient way to trade on thousands of global financial markets, including shares, indices, foreign exchange, treasuries, and commodities. If you think the product will go up in value, you can buy a number of units or go long. If you think the product will fall in value, you can sell a number of units or go short. Each product has a sell and a buy price. The difference between the two is called the spread. Your profit or your loss is based on the difference between the price you enter at and the price you exit at. The more points the market moves in your chosen direction, the more profit you make. This difference, multiplied by the number of units, equals your profit. If the market moves in the opposite direction, you will make a loss. Depending on the currency a product is quoted in, currency conversions may apply. You don't need much capital to get started either, as you don't have to outlay the full value of your position, just a small percentage. This is called trading on margin. Since you don't own the underlying asset, there is no stamp duty to pay. Many products are available even if the underlying market is closed. This lets you trade 24 hours a day, 5 days a week.
So what are CFDs? Well, CFDs stands for Contracts for Difference. It's essentially an agreement between two parties, usually a retail investor or trader and his or her investment bank, or more usually a broker, spread betting firm or CFD provider such as markets.com or OPC Markets.com. The important thing about a CFD is really that you can go long or short, so it allows a degree of flexibility in the type of trading strategies that you want to pursue. It can be used as a hedge for real world investments, for physical investments. For example, if somebody owns stock in ExxonMobil, they have a natural desire for that stock to rise. They may, however, decide in certain circumstances to take out a short position on a ExxonMobil CFD in order to counteract any downside in the stock should they expect that to happen. Important thing about CFD trading is it can be done on margin. Now that means that you are carrying out a leverage trade, and what that means is that you do not need to deposit the full amount of money in order to control your position. So for example, if we're trading oil on a margin ratio of 10-1, you could control $100,000 worth of oil contracts for $10,000 in your account. Now that's important as a starting point, and it can change because as the value of that trade changes, you may be required to increase your deposit amount to cover the working margin that's required. That's really the basics of CFD trading. We'll go into more detail later on.